Good afternoon, everyone, and welcome to the Federal Home Loan Bank of Chicago's weekly market update. My name is Jessica Nick, and I will be moderating today's call. I'm glad you all could join us today. We are really excited to have two special guests here from Market Alpha Advisors to give us some insight on the LIBOR transition, what's happened, and what's ahead. I'm joined here today with Michael Kogler, Managing Principal at Market Alpha Advisors, and Peter Van Vredenberg, Principal at Market Alpha Advisors. Michael and Peter, thank you so much for offering your time to join us today. Before I turn it over to you, I do want to note a few housekeeping items. We will have approximately 15 to 20 minutes at the end of this webinar for questions. The phone lines will remain muted throughout the call, however, so if you do have any questions, feel free to type them into the GoToWebinar question box on the right side of your screen whenever you have your question, and we'll go through them all at the end of the call. I know we're all very excited to get started and hear your insights on LIBOR, so without further ado, I will hand it over to you, Michael and Peter.
Great, thank you, Jessica. Greatly appreciate that introduction. Good afternoon and welcome, everyone. This webinar is going to be on navigating the LIBOR transition. Want to express our sincerest thanks to all the folks at the Home Loan Bank of Chicago for inviting us to present to you this afternoon. And as Jessica said, this webinar will be available for replay, and the slides will also be made available to all of those that registered. So I'm Mike Kogler, Managing Principal of Market Alpha Advisors. Let me see if I can switch. Jessica, can you go to the next slide? Yeah, perfect. Thank you. So Mike Kogler, Managing Principal at Market Alpha Advisors. Market Alpha Advisors is a market structure and fintech advisory firm that specializes in providing strategic guidance and subject matter expertise across a broad range of issues affecting the financial markets, including, of course, the LIBOR transition. So Market Alpha obviously is spending a lot of time talking to folks about the LIBOR transition, and some of the expertise that we provide is listed here on this screen. It goes all the way from helping you with your governance structure, your communication strategy, identifying your LIBOR exposure, your product strategy, contractual remediation, advice on accounting, tax, and regulatory matters, and finally to implementation and conversion of your contracts. So Market Alpha specializes in helping clients unpack all of the complex issues related to market structure and, of course, in this case, the LIBOR transition. And we're available to help you go deeper and investigate some of the more granular details, along with the ability to tie all this back to your own organizations. And so with that, I'm going to introduce Peter as well.
Thank you, Michael. Thank you, Jessica. Thank you, everybody, for joining us in these slightly very exciting times. My background is I ran the rates, sales, and trading for UBS for 21 years. Then I ran the trading desk for a couple more banks. Ended up at HSBC, where I was the head of global markets treasury for the Americas, and I was their representative on the infamous ARRC, the Alternative Reference Rate Committee, that started this whole exercise of the LIBOR transition. So if you're looking for someone to blame, I'm one of those 15.
All right, very good. All right, with that, so let's jump into the first slide. So, you know, as many of you are certainly aware, the LIBOR transition brings with it significant challenges to the financial services industry, as well as, you know, any firm that has assets or liabilities referencing LIBOR. This subject matter is highly complex and has implications throughout every part of the organization. So we only have 60 minutes for this webinar, so we're not going to be able to do a complete deep dive into all of this subject matter, but what we'll try to do is present the broad themes and the issues as it relates to members of the Home Loan Bank Chicago. So before we get into some of these issues, I think it will be useful to talk about how we got here. And that's what this slide is, basically. Why is LIBOR being eliminated in the first place? Well, you have to go all the way back to the 2008 financial crisis, when the LIBOR OIS basis widened dramatically. So that was pretty instrumental in demonstrating that the Fed has little control over the level of the LIBOR rate. And that was something that was very obvious during the 2008 financial crisis. In addition to that, in 2008, reports of abuse by the banks related to the LIBOR submission process started to surface. This led to basically what turned out to be the global IBOR scandals. There were over 12 billion in fines and civil penalties levied against the submitting banks, and in fact, several cases led to imprisonment for certain individuals. For these reasons, ICE has been handling the administration of IBOR resets and relieving the banks from the administration process. So that sort of is a brief overview of what got us here, and Peter can sort of pick it up to where we are today.
Absolutely. Thank you, Mike. And one quick thing to add to that, actually, even in, I believe it was 2016, BNP stopped contributing to the LIBOR index. And that already was the first warning sign of all this. Right. So the one thing I would like to add for this now is that when the ARRC got put together by the Fed to look for this replacement rate, their initial thought had a much longer timeline than it does today. They were looking for the 10 to 15 year, transition process for all new products, and then slowly transition it out that way.
And you were on the committee at this time when this was
absolutely. We had monthly meetings with the Fed, and actually, highly ironically, is that the chairman of that committee was none other than Jerome Powell himself.
Right.
So he is very well versed on this subject. Then in the summer of 2017, Andrew Bailey, who was then the head of the Financial Conduct Authority, the regulator for the United Kingdom, made a little speech. And in his speech, he said, look, I've asked the banks to basically continue to contribute to LIBOR until the end of 2021, but I will allow them to stop doing that after that date, i.e., he put an end date, a potential end date to LIBOR in that speech. In our next meeting, the one after the speech that we had as an ARRC, there was actually visible fear from the Fed.
You were at that meeting.
Absolutely.
Yeah.
So what basically happened at this stage is two things. And this is, I think, very important for everybody to understand. First and foremost, the Fed does not control LIBOR. The Fed has no control over LIBOR, the setting off or anything else. It can't ask banks to set LIBOR. This is not their domain.
They can't extend the deadline.
They can't extend the deadline.
Right.
The second part, obviously, that was very scary for the Fed is that suddenly the entire conversation that they were having with the 15 banks changed to not just future trades, but now all legacy positions as well, and everything else. So from that perspective, I think it is crucial for everybody on this call to really understand the likelihood of there to be an extension or that the Fed will ask banks to continue, the American banks continue selling LIBOR is very, very small in our opinion.
Right. Absolutely. Yeah, I think it's dangerous to assume that somehow the demise of LIBOR is going to be extended. Okay, so what does this mean? Well, this is a huge problem for the U.S. As you can see from this slide, it is estimated that there are over 200 trillion in notional contracts tied to U.S. dollar LIBOR. Okay, the number is actually larger if you consider other IBORs around the world, but obviously the focus for this webinar is U.S. dollar LIBOR because that is the primary makeup of the members for Home Loan Bank of Chicago. But as you can see, LIBOR touches so many different instruments across the entire financial market. And it touches money market instruments, loan products, obviously derivatives, and structured products. It's ubiquitous throughout all types of consumer debt, mortgages, home equity loans, student loans, credit cards, and of course, home loan bank advances, which obviously is very relevant to this conversation. So this is an all-encompassing situation that the financial markets have to deal with.
And just to add to that, the scariest part of this slide is still, we're adding to this problem every single day still.
Right, because people are still entering into LIBOR transactions as we speak.
And as obviously all of you know very well, this isn't just a professional's problem. This isn't just bank to bank. This is very much a Main Street problem as well.
Absolutely. So what does this mean for an institution? I'm going to hand it over to Peter right now. This is actually his favorite slide.
This is absolutely my favorite slide, and I think it's, I know there's lots of little words on this slide and probably not always easy to see for everybody, but it's a very good one for everybody to study afterwards. Is what this slide truly illustrates for everybody that has any LIBOR exposure at all is that it is absolutely essential for any organization to set up the correct governance structure. And the governance structure has to be has to have the power to basically have a say and some control over all of these types of areas. From your business, your front office, obviously legal, we know how important that is. The treasury function is, what are you going to use for your transfer pricing? Accounting and tax, what are the implications? We did a webinar a couple of months ago with an accounting firm. There's different rules for different trades at different times. Obviously the operational side, can we handle? What is the new rate? Which immediately leads you to the IT and infrastructure side. And then there's always the overriding side of the compliance. What can we do? What can't we do? What is allowed? What isn't allowed? But I can't reiterate enough times that this governance structure that you have to put in place and you have to make sure, because the other piece of this puzzle is all of these areas are very much interlinked. There's no point your front office or any one of you to talk to your clients if your legal department isn't ready, or from an operational point of view, you can't handle the trades yet. Because if suddenly you've talked to your client and says, okay, fine, let's transition away from LIBOR to rate X or index X, but IT and operations can't handle it, that's a pointless conversation and only leads to more frustration. Very closely following this, and this is why I've left out the market risk perspective, is once you've created this proper governance structure, the next thing that everybody has to realize is if you have LIBOR products, you have a new risk in your portfolio. And that risk is your fallback risk. What happens? What does it say in the contract? Does it say anything in the contract? what is your fallback risk of your portfolio, and you need to understand it. Between Mike and myself, having talked to God knows how many clients, from banks to asset managers to insurance companies and everybody else, there isn't a risk system currently out there, right, that anybody has integrated into their world that creates this fallback risk. And it's not a generic risk. It's massively different from trade to trade, or from security to security, from domain to domain. You have to understand, and you have to understand, what is it that I now have in my portfolio, so you can then start making rational decisions accordingly.
Absolutely. And that leads me right to my next slide. So Market Alpha has proprietary software that has the ability to read large numbers of documents to identify, extract, and classify embedded LIBOR fallback language. This slide here shows a small subset of this output that we generated for one of our clients. As you can see, some of this language is extremely complex. And as Peter mentioned, right, if you have a portfolio of LIBOR assets or liabilities, it's very easy to see what the maturity is, what the principal amount is, what the roll dates are. You understand it's indexed off of LIBOR, etc. But no one ever anticipated that LIBOR would go away. So the information of what happens if LIBOR fails to set doesn't exist out there on any of the analytics platforms or anyone's back office operational systems, right? The only way that you can figure out what happens if LIBOR doesn't set is to go and actually read the documents and see what's embedded in the documents in terms of the waterfall if LIBOR doesn't set. And so that's what this report does. This report looks at, it pulls out fallback language from prospectuses, whether, can pull it out from consumer mortgages, home equity loans, whatever the document is, it can go through, figure out where the LIBOR language is, and pull it out. And this just gives you an example of what we're dealing with. And I'm not going to go through all of this, but if you look at the last row, this is one of my favorites, okay? This, the last one is a perpetual preferred security. It's preferred stock, okay? Issued by RBS, and I'm looking at the last line on the spreadsheet here, okay? So what happens if LIBOR doesn't set on that deal? So the way that the language reads, you go and you poll 5 banks in London for a LIBOR rate. If you can't get a LIBOR rate from those 4 or 5 banks in London, you poll 4 or 5 banks in New York. You can't get a rate from them. Well, what do you do? You take whatever the last LIBOR setting is, and that's what you use. I can't begin to tell you how toxic this is. This particular bond has no maturity. It has a coupon of LIBOR plus 175. So if you're an asset manager, if you're a bank investment portfolio, and you're holding this bond, it's got a duration of whatever it is, 3 months, okay? If LIBOR doesn't set, guess what? Now you have something that has a duration of 50 years, okay? So this is something that I think is puts a spotlight onto some of the problems as it relates to LIBOR fallback language.
Absolutely, Mike. And just to add to that, even if you have written a loan and the loan has a derivative on the back of it, you have a very good chance that the fallback language on those 2 instruments is different. So in the negotiations of trying to renegotiate this, you have to make sure that you understand what it is. Also, when you start a conversation with anybody to try and transition out of it, the starting point will always be the documentation that you have. Hence, understanding this gives you the starting point of transitioning people away from LIBOR.
Right, exactly. And I think that this illustrates the fact that this is not really a legal, just a legal or a compliance issue. This is a market risk issue. Okay?
Well, I would actually add to that, Mike. It's a market risk issue. It's potentially a compliance issue, because if you know that you have these terms in it, to what extent are you supposed to convey that to someone else? It's a front office issue because, as you just said, is when you start your negotiations with someone, that's where you start. So that would be the front office person. It's an operations issue because depending on what it says here, can we handle it, what potentially the fallback language is. Imagine the fallback language is prime. Can your system handle prime? Right? So all of those things. So, and this is again what we reiterate. A lot of these problems aren't singular in its legals, its compliance, its IT. They're universal. They touch
across the whole organization.
They touch the whole organization.
Right. Okay, great. Let's move on to that. And now we're going to talk about some of the potential replacements to LIBOR.
So now that you've sorted out your governance structure, you fully understand what your position is, what your potential fallback is, now let's get to the really interesting part. What are the potential alternatives to LIBOR? On this slide, we have some, just quickly, some of the alternatives. We have commercial paper. Commercial paper was much more, I'm going to date myself now, much more popular. You had non-financial, financial commercial paper. It traded quite actively before the financial crisis. Banks used to issue quite a lot of commercial paper, so it was quite a viable index. It has died off a little bit. Could it come back to life? Absolutely. Do I see it coming back to life? And do I think it's a really viable index to use as a pure replacement to LIBOR? I don't. Fed funds OIS. Now, this is a very interesting one. It's a very natural one. It's probably the one that the UK in their transition has picked something much more similar to this. It's an existing rate, which is SONIA, which is an existing rate. When the ARRC was put together, of the 15 banks, all 15 immediately said the new rate should be Fed funds OIS because it exists, we all use it, it's very liquid. The Fed then turned to us and said, you can't use it, we use it for policy decisions, so you have to try again. That doesn't mean that you, as customers and banks, you can't use it. The only thing that I will caution you a little bit with on the Fed funds OIS side, it is very liquid today because we use it in the funding and the pricing, especially for our clear derivatives, our collateral agreements, and everything else.
All based on OIS.
Right. So we use it as our, what I would call as our financing rate. And we're going to talk about this a little bit later, is later this year, all of that financing rate is going to, OIS is going to be replaced by SOFR. So any clear derivative transactions at CME and LCH will be replaced by SOFR. This, and it won't be an immediate thing, but this over time will reduce the liquidity, and especially the liquidity further, the longer maturities away from OIS Fed funds. But it is still a very viable rate for the time being, and it will still remain liquid, especially on the shorter duration. Prime. Prime is, at this moment in time, very much tied to Fed funds, as you all very much know. It will be used, it is already used. I don't see it as the predominant replacement to LIBOR.
And also, one thing to mention as well with Prime is it's pretty much 100% correlated to Fed funds.
For now.
It's 300 basis points over Fed funds. For now, correct.
For now, but that's not written in stone. So then we have America's LIBOR, or Ameribor. Mike, if you can just switch to the next slide for 1 second, this is a very inventive rate. It trades on the exchange. It has, good compliance and oversight from the CBOE. From an overnight perspective, it works very well. It has a credit component. It allows a lot of you as smaller banks to transact your cash balances with each other over here. I would say that the very minor drawback at this stage would be it doesn't really have a term structure to it. And it might still be at this moment in time not quite be robust enough
in terms of liquidity.
In terms of liquidity, to truly be the ultimate replacement to LIBOR. Should it stop you from using it? No, I don't think that. But it's not the overall replacement to everything. So to go back to the previous slides, is you just have to be careful of how much work do you want to do on multiple indexes, on multiple stuff. How much, because you have to get your IT ready, you have to get your operations and everything else. So that might just be too much. Then the next index would be the US dollar ICE Bank Yield Index. This, again, over time, is going to be a really interesting index. It will take SOFR plus a credit spread. The issue with this is, and the operative part of this is, it's over time. It doesn't exist today. It's conceptually very, very nice, but because it doesn't exist, we just need to forget about it because we have an end date. We need to meet that end date, and this isn't going to be part of it. Then we have zombie LIBOR. Zombie LIBOR basically means LIBOR set by less banks.
Sounds like a horror movie.
It is a horror movie, but the whole LIBOR thing is a horror movie, back. Again, zombie LIBOR is a terrible strategy and something we all need to be very aware of, and something that we actually don't want to see. And then last but not least, we have SOFR. Mike, if you just go forward 2 slides.
Yep.
Obviously, for all of you, I'm just going to quickly go over. SOFR, right, if we go back in time, the Fed's prerequisite for a new rate was it has to be a tradable rate. They don't want anything that requires any kind of polling. It can't be manipulated, right? They want to avoid that at all costs. So it has to be enough depth to it, et cetera, et cetera. And it needs to be able to trade in all economic conditions, market conditions. So that really left just the repo market. The overnight repo market hits all of those. That makes SOFR very strong. It also has some tremendous negatives to it. First and foremost, it's a secured rate, whereas LIBOR is unsecured. All of your funding is on an unsecured basis. So to say that I'm going to base it on a secured rate, whereas my own funding is unsecured, it creates a new risk that you don't know quite how to hedge out yet. And neither does anybody else at this moment in time. And then the most important piece, in our opinion, is what it's really, really lacking, is a term structure. If there was one ask, if you could all get together and write the next letter to the Federal Reserve and to Jerome Powell himself, it would be to say, don't wait until the end of 2021 to create a forward-looking term structure for SOFR. We need that today. The transition from LIBOR to SOFR would be much easier and much more acceptable if we had a forward-looking term structure to it. The reason the Fed doesn't allow it is because the Fed doesn't want any derivatives written on it. That's why they're holding off. That's why they're not allowing the CME to create anything. But this is where I think more pressure will come, and this will happen over time. And at that time is, I think, well before the end of this year.
Yes, right.
This very quick graph here, we just put it in, is because I know that it's always at the tip of everybody's tongue when we talk about SOFR, that obviously we had the massive spike in last September. Having been very involved in stress testing and capital of banks. We could spend a whole hour on why did that spike happen. The predominant news is that it did happen, and that the Fed has figured out why it happened truly, and that the Fed will never allow it to happen again. Well, never is a bit of a reach, but it will definitely not happen again for the next 2 years. Of that, I am 99.8% certain. We saw the stability over year end, and the Fed will do whatever it takes now to really stabilize this rate.
Okay, and just so everybody is aware, this shows a timeline for the LIBOR transition over the last few years. And what's important about this slide is it shows some key dates over the next, what is slightly less than 2 years until the demise of LIBOR, that I think everyone needs to be aware of. And first, the first date coming up is actually very relevant to the Home Loan Bank of Chicago and its members, and that is that the FHFA came out with guidance recently saying that the home loan banks should not be adding any new LIBOR assets and liabilities that mature past 2021, past March of this year. So that includes advances. So that means that the home loan banks are, per guidance from the FHFA, are not supposed to be doing advances on LIBOR if they mature past December 2021. So what that means is basically, and I don't want to speak for my friends at the Home Loan Bank of Chicago, but they have a requirement where they have to phase out LIBOR advances and are going to be transitioning to something else, most likely SOFR. So that's obviously a very important date, which is occurring this month. Next on the list is that swap dealers, per guidance from the ARC, from the Fed, should be streaming SOFR swaps to electronic platforms by the middle of this year. Now, I can tell you that recently we went to see our friends at Bloomberg, the Bloomberg SEF. They only have 2 dealers, at least at that time, they only had 2 dealers streaming SOFR swaps to their SEF. And that represents over 50% of the electronic trading in the swaps market. So that's obviously very concerning. And we would expect that the number of dealers that are contributing to streaming prices on Bloomberg and TradeWeb, that should increase. But for right now, there is not a ton of liquidity, at least in the electronic market. Another very important date, as Peter mentioned earlier, is in October of this year, LCH and CME are going to move to SOFR based calculations for PAI and discounting. So as Peter mentioned, right, for clear derivatives at LCH and CME, they're not going to be using OIS anymore. They're going to be using SOFR. So that's going to be that's going to have a big impact on the market, and it should increase significantly liquidity in SOFR-based products. And in addition to that, guidance has also come out that PAI for CSAs on interdealer swaps in the interdealer swap market should move to SOFR as well by the end of this year. So that's another important date that should add liquidity to SOFR. And then by the middle of next year, basically no new swap contracts are going to be accepted for clearing based on OIS. Okay, so you know, LCH and CME are going to begin moving to SOFR in October of this year, and by the middle of next year, they're not going to accept any more OIS discounted instruments. Okay, so that's another important date. And then finally, at the end of December 2021, obviously the FCA has said that they're not going to require banks to submit to LIBOR anymore. So who knows what's going to happen after that date? We don't know, but we know for sure that everyone who has LIBOR exposure in these markets really needs to understand their risk and prepare for what may be the complete cessation of LIBOR. And that brings us now to our last slide, which is second to last slide. Where are you on the timeline, and what should you be doing potentially?
Yeah, absolutely, Mike. Mike and I have talked to lots of different users, issuers, from banks to asset managers to insurance companies, and pretty much everybody in between. The transition of LIBOR is unbelievably daunting because it's like water. It has seeped into everything. And what makes this very different than other, regulatory things that we've had to do, like a Dodd-Frank, this isn't mandated. The Fed hasn't told you to do it. It has just said, be careful, it might not exist, right? But nobody has specifically said this is going away. This is not a Dodd-Frank where I will send you a document, please sign here because these are the new rules, right? So that's what makes this even more daunting. And it's unbelievably complicated. This isn't a simple thing of this product or that product. Also, what also makes this much more complicated than most of those other things is that every one of the transactions that you have that's LIBOR based or something, it's not just your prerogative. It's not just your problem. There's somebody else on the other end of that trade. So if you're ready to transition, but your counterparty isn't, or they don't understand, or they don't know what they're doing, or they're not ready, nothing is going to happen. And that could be another tremendous problem for you. So the way we like to think about it, and that's, again, I think this is an important slide here, is you have to think of this entire process in different phases. Obviously, and thank you for it, that you're on this call today, this is the awareness. We all now understand that we're getting there, is where this is going to happen, this is probably not going to be an extension, I can't think of an extension, and now you need to start doing those different phases, setting up the governance, setting up, right, understanding what is the fallback language, what are the goals, start having those internal conversations. When do we think we should stop? What should we be doing here? Is as long as within that and within the governance structure that you set up, you understand the different phases and you understand what needs to be done, right? It becomes less daunting. One of the things that we at Market Alpha, we advise a lot on, and we hope to hear more from you, it's also educational. You have to make sure not only that you yourself get educated, but throughout your organization there needs to be the education. And then you need to also make sure that your customers are properly educated, right? One of the things is, and we will talk about this a little bit more in the end, is this is also something because of the fact that every single bank, asset manager, we're still participating in LIBOR, we're still trading LIBOR, we're still buying LIBOR products that have a maturity date past 2022. It really opens everybody up for tremendous litigation risk, right? You are playing with fire every time. If you write a loan, you write a mortgage, you do something that has a maturity date past 2021, you're playing with fire because what we've just discussed, this transition isn't clean. I'm not going from LIBOR 101 to LIBOR 102 and they pretty much look alike and there's not that much of a difference. No, there's a tremendous difference in all of this. So therefore, within this, the timelines are crucial, the education is crucial, and then you can start, once you understand what you have in-house, then you can get to the next phases in this, client outreach, client education, adopting, and then eventually actually changing the securities, the contracts, and everything else. But if you think about it from start to finish, you'll just want to take a vacation and not really think about it anymore.
Yeah, but it's clear. So this timeline really just gives you a rough idea of how you can structure your transition process in a way that gets you prepared for the end of 2021. So every organization is going to be different, and this may not apply to everyone, but it certainly gives a basic outline of where you should potentially be in the process. So with that, just some important questions for you to think of the answers to as you start getting your hands around this process. One, first and foremost, do you understand the risks of the cessation of LIBOR? Do you understand what the implications are? Do you understand the risks to your organization? That's number one. Number two, where are you in the process? Do you need help? Have you set up your governance structure? What phase are you in, or what phase do you think you're in this process? And obviously the third question, have you set up the right governance structure? Do you have different senior individuals at different parts of your organization that have responsibility and accountability for making sure that deadlines are met as it relates to the LIBOR transition? Do you understand your LIBOR exposure? This goes back to that slide where I showed everyone the fallback language. It is complicated. Do you understand? Don't just think that, oh, we're just gonna switch and move to SOFR in a couple of months. No, you have to go and look at your documents and understand what that fallback language is, what the waterfall is. You may be surprised at what you find. And that goes for contracts you have with your partners, with your providers, as well as your customers. What's your communication strategy with your stakeholders? Have you thought about that? Do you have something in place to communicate this with your customers, with your stakeholders? That's obviously very important as well. And then, do you have the resources for this? A lot of firms we talk to don't really have the resources to handle this themselves, and they're looking for outside help. So, we can help with that process. We can help refer people. Whatever the need is. I think it's okay to ask for help. So with that, obviously, here's our contact information. We're also going to open it up for questions. Jessica, do you have any questions from the online audience, or any questions that you guys want to ask at this point?
Yeah, thanks so much. I have a full page of notes from all this content, so it was awesome. Thank you. As you said, we'll open it up to questions. I think we got one during the call, but if you do have a question right now, please feel free to type it into the GoToWebinar question box on the right-hand side of your screen. Phone lines are going to remain muted. So I'm going to start just with a question that we actually hear from our members all the time, and you alluded to a little bit, but we're hoping you could maybe give a little more color. So obviously SOFR on a day-to-day basis has been more volatile than LIBOR or Fed funds. But with the Fed anticipating winding down its repo operations in April and ending those T-bill purchases sometime in Q2, do you see another repo blowout occurring similar to last September, or at least being more volatile than it's been since then?
That's a great question, Jessica. And I would anticipate no. I think that the Fed realizes by, for lack of a better phrase, forcing us into the SOFR rate and making sure that we do all transition to this rate. They know now how to control it. They know how to keep it stable. I fully anticipate that even with those things, that they will keep this rate and the repo rate as stable as possible. Right?
Well, yeah, I mean, they have to, right? They have, they are telling the market that this is the rate that they're supporting. And if there's this volatility like occurred last September, that really undermines the entire process.
And I think that also, look, over time, as both the futures market and the OTC market becomes more and more mature, more and more liquid, and much deeper, then the Fed can slowly back off and let it trade slightly more by itself. Mm-hmm. But for the time being, that isn't the case. So I fully anticipate that this will be a very stable rate compared to Fed funds and all the other ones for the next at least 20 months.
Right, and I'm sure going forward as well, right? So hopefully that answered the question, Jessica. Do you have any follow-up or any other questions for us?
No, that's great. I think that's some great insight, and I agree with you. I think that the rate will hopefully be more stable, despite the Fed rolling off a little bit on the liquidity stance. But a little bit of a follow-up to that is, do you foresee a term SOFR being available by the deadline? And if it's not, what are some drawbacks or implications if it's not ready and contracts begin to fall back to an average plus spread?
Again, great question. I hope, and look, I'm actually quite amazed that in this case, and I'll use the CME as my example, considering that they have the futures market, they clear the OTC market, and the fact that pretty much every single participant in the marketplace is looking for that term type of structure, right? It would make life much, much easier for everybody. And there is no reason, the only reason that it doesn't exist is purely because the Fed doesn't want it to exist at this moment in time. And why doesn't the Fed want it to exist? Because the Fed fully realizes that if tomorrow there is a forward-looking 3-month SOFR, that every single swap and everything we do on the derivative side will move to that rate rather than the overnight rate, which is the true setting of SOFR. But it is a necessity if this process is to truly gain some traction more effectively. I think the slight drawback here is, and this is, and I don't disagree with this for people, and we advise it accordingly. It's really hard, right? And this is where the Fed needs to just step up and get on with it, because from an IT perspective, from a settlement perspective and everything else, you don't want to do all this work on a compounded weighted average rate. Mm-hmm. If in 6 months' time, oh my God, here's a forward starting 1 month rate, and that's much easier. Right? It would be an unbelievably frustrating process. But hence, I ask all your member banks and everybody on this phone call, the pressure that needs to be put on the Fed needs to be that forward-looking term structure pressure, much more so than anything else. Because from the loan perspective, even from a derivative perspective and everything else, from a mortgage perspective, that makes perfect sense. Mm-hmm. I do anticipate that before the deadline, there will be a forward-looking term structure to SOFR in 1, 3, 6, and 12 months.
Great. That's very helpful, and that would be amazing if that's all available before the deadline, definitely. One last question that we have so far is, what is the likelihood, do you think, of having 2 alternative reference rates existing at the same time? Meaning, do you think Ameribor will continue to gain traction, and will it ever be cannibalized essentially by LIBOR, or by SOFR, I'm sorry?
Well, my belief is that because this whole task is so daunting and there's so much to be done, is that there is definitely place for both of these at this moment in time. Just there's always been a place for prime, for commercial paper, there was a bills market, a bills basis swap. So yes, there is absolutely. The one thing that I also am very much believe is that once we get comfortable with this transition, and once 2021 has come and gone, there will be tremendous innovation back into the financial marketplace. We totally understand, and none of us is pretending that this doesn't exist. SOFR isn't a good hedge for many products. SOFR isn't a good rate to do your transfer pricing on. But it is what we have today, and we don't have the bandwidth, and the banks don't have the bandwidth, and everybody else, to continue to switch, to ask your vendors, hey, by the way, I don't just want this, I want this and that, and I want to be interchangeable with this. That's not all possible. But I truly believe that will all come in due time. We just can't have it today. I think MRIBOR is a very viable index. I think it is. It's very much there. It serves a very good purpose today for the smaller banks in transferring their overnight balances. Again, the slight reservation I have today is if you're trying to do a slight term structure on MRIBOR, that gets a little bit trickier, right? Because we don't know what the stability of that is in a slight economic crisis, or could it potentially be manipulated if you did a 1 month MRIBOR on this? Those are the things you don't know today. The other part that we've talked about earlier and that Mike has mentioned as well, we all also have to keep slightly in the back of our mind, with this process being as challenging as it is, there's going to be lots of upset people, and those people will probably be our customers, right? Not so much my customers, more likely your customers. Mm-hmm. And upset customers will tend to eventually think about some kind of litigation. And so therefore, when you make some of these decisions, you always have to keep that in the back of your mind.
Yeah, who is it? Randall Carls at a speech. Charles said that the LIBOR transition was a quote unquote DEFCON 1 litigation event. That was his quote, quote unquote. So we think that there's a significant possibility of litigation on the back of this, especially if you are entering into LIBOR transactions today with customers, or over the last 6 months or a year, you've entered into LIBOR transactions with customers knowing that LIBOR was going away, and then LIBOR goes away and you convert those contracts to SOFR or something else, and that customer loses money as a result of that. They may turn around and say, well, wait a minute, you never told me about this. I entered into this transaction, I thought it was LIBOR, now you're telling me I lost 50 basis points? You know, I want my money back. So that's a very real and scary potential probability. That's why you really need to do everything in your power today to prevent that from happening.
Yeah, and I think
it's the rules of what was the quote that you said? It's not the rules of today you have to worry about?
Well, basically, what I like to say to customers, you won't be judged on the rules of today. You will be judged on the rules of tomorrow. I mean, there are still, there's still lawsuits happening today from stuff that happened in 2007, right? We don't know what the future looks like. But a huge part from us is, and what we advise everybody is, that first line of defense starts with education. Making sure both you internally, but also especially externally with your customers, that you educate them. You can't just send them a letter and say, hey, by the way, converted your loan to SOFR. The rate is SOFR plus 20 basis points. Good luck, right? That's what we've done. There has to be an explanation. There has to be, this is what's happened, this is why we did it, and this is the, and it depends, right? It's going to depend from customer to customer and thing to thing on how complicated you want to get with that. But you have to have some dialogue with your customers before you think about converting them. And that educational piece is, it's a very, very cheap option at this stage compared to the litigation risk you run on the other end of it.
Yeah.
Yeah, those are really great points and great quotes, actually. I love the DEFCON 1 from Quarles. But you bring up a really good point on educating your customers early and notifying them in a way that they understand. Do you have any other comments you want to add to that? Otherwise, that was our last question, or anything else in general would be great.
The CCAR thing?
No, I do. I also think from everybody on the call is, if you look at the United Kingdom and the FCA, they have pushed this issue much, much harder than the US has. They've just come out with another regulation just the other day where the
asset managers, right?
Well, the asset manager with the Dear CEO letter, but they've also posted that any LIBOR collateral at the end of this year will have a 100% haircut, i.e. it will be not acceptable. The UK very much looks like they'll easily hit their deadline of the end of 2021 with having transitioned away from sterling LIBOR. Now granted, that's not, it's a much, much smaller market with much less integration, and they switched to a rate that has already been in existence for 15 years. The point here is that the Fed has to eventually turn honey into vinegar. It has to force the issue harder. The simplest way, in our humble opinion at Market Alpha, is that they're going to do this through CCAR, through stress testing, where they're going to make you pony up capital for your LIBOR exposure on a notional basis. And once that starts to happen, that's the true panic button, because the thing that will follow that is the most almighty pecking order, i.e. just because now you want to get rid of the transaction, again, it doesn't mean that your counterparty is ready for you, right? Mike might be my biggest counterparty, but I might only rank at number 15 with him, in which case he's got 14 people he'd like to call first. So it's very important for everybody here. You have to start getting ready, because the Fed knows it has to start forcing this issue if it wants to hit the deadline. And it cannot. And I will be highly suspect if it will ask the FCA to extend that deadline. So our final point here is, that the best part of this webinar is, for all of you, is that neither Mike nor I know who you are. The good news for all of you is you now know who we are. So if you do have any further questions, you want to follow up, you want to discuss further on from the governance structure to the education structure, please don't hesitate to reach out to us. We're ready, willing, and able. And thank you all very much.
Yes, thank you, Jessica. Thanks to everyone at the Home Loan Bank of Chicago and all your members, and thanks for everyone that participated on this call.
Great. Thank you so much. And again, just to reiterate what you just said, thanks everyone for joining us. As a reminder, we'll be back next Thursday with our regular weekly market update at 3 p.m. And if you are interested in getting these slides or a copy of this webinar recording, it'll be posted on our internal e-banking website shortly. Or if you have another request, feel free to email me directly or Michael or Peter. And thanks again, everyone, for joining us. Have a great afternoon.
Beautiful. Thank you.
Thank you very much.
Thank you.